Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, November 29th, 2022. It's 1:54 p.m. Eastern Time. I'm starting the video, so we have about a couple hours left in the trading session. And what I'm going to do today, first video since the Thanksgiving holiday, is just an overview on the main things, the big stuff. That is the stock market. We'll look at a couple of the major indices, look at Treasury bonds, gold, silver, and the mining stocks. If time permits, I'll get into crude natural gas in the energy sector, XLE. Otherwise, I'll just cover that in another update. Just trying to keep these videos manageable as far as time goes. All right, big picture, S&P 500. We are just to kind of recap, and maybe you're new to the site or just catching up on things after a while. So I have a couple boxes here. This red one right here, I'm going to box in with, of course, a purple tool. Makes it more confusing because I have a purple box above it. But either way, that's just my drawing tool color right now. That is the what I figure to be a most likely, the most probable bounce target zone for what I still believe is a bear market rally. So only time's going to tell whether the bear market ended here, like many are calling for, or whether this is simply another bear market rally, just as this one was, and just as this one was, and this one, and that one, etc. Okay, so time's going to tell, but the most important takeaway is we hit the bottom of it, and that level is there for several reasons. There's some price resistance. I have some gaps right here and some levels. I don't have a hard line on there right now, but it's about 402, 403 price resistance. There were some Fibonacci retracement levels, quite a few sectors and indexes hit recently. And then if we turn off all the levels, two of the most reliable trend indicators as far as bigger picture, the 200-day moving averages. I have a red line here, which is the 200 exponential, which we just hit. We actually hit it there, and then we hit it 2 more days right there. And then just above that is the 200-day simple moving average. So simple is just going to follow the index or move a little slower in response to changes in the index because of the calculations involved. And I always state that I use both because some traders use one, some use another, and therefore I'm going to use them both. Last time they sold the 200 simple there. Here they sold the 200 simple. Sometimes in a bear market, it's not unusual to see one index climb, but at that point in time, you had the S&P 500 after taking it out a couple times, pierce back above it, and then you had at the very same time what I considered and still do to be the most important index, even though it's not as diversified. The S&P 500 is more representative of the overall economy, but the NASDAQ 100 has a higher concentration of the market leading stocks that the mutual funds and the investing public are chock full of, and that's Apple, Amazon, Microsoft, and those big names like that. They just have a higher weighting, even though they appear in the S&P. So this rightfully so. This was my preferred shorting index on the way down, and it fell a lot more than the S&P 500. You're going to get that in a bear market because the S&P 500, if you short it, or in either proxies such as SPY, the ETF, or the futures, you're shorting 500 of the most bearish companies like Apple and Amazon, which fell hard, and Meta, for example. But you're also shorting the most bullish companies. You're shorting defensive issue companies such as utility stocks and healthcare stocks, things that tend to hold up relatively well relative to the overall market. And so this is just a more concentrated play on the stock market. All right, so, and you can see again, there's an example where some traders in a vacuum, they trade SPY and they look at the SPY and ES charts only, and they're not watching QQQ hitting these moving averages. They might have figured that the breakout back above those levels at the same point in time was bullish on the SPY. So that's why I watch them all. And in the primary trend, you give the benefit of the doubt to the overall trend. And what I mean by that is, if you're bullish and you're looking, for new highs, you can acknowledge the breakout back above the 200s there, but then you also have to look at the other major indexes, other key leading stocks, for example. If the S&P pierced back above there, but you have Apple, Microsoft, Alphabet, Amazon, Tesla, all those below their moving averages, that's not a buy signal in my opinion. And it wasn't. So that's where we're at, guys. So let's keep it very, very simple. We start taking those out with conviction in both the S&P 500 and the NASDAQ 100. It's going to be a different story. Now, the S&P 500 is testing, or just relatively close. We've been testing the 200s recently, and the NASDAQ 100 still has some room to go. And so that's why I'm very much open to, and at this point in time, I don't have super strong convictions that we could see the S&P 500 take out again, those moving averages. And even if they did, let me turn back on my boxes. So I have my most likely scenario, which comes in with this downtrend line right here, the primary downtrend line off the highs. It's nice, clean downtrend line, clean because we have 1, 2, 3 distinct reactions so far, and if we rallied up there again, that would be a fourth test of that level, and you'd likely see some sellers step in at least at minimum on the initial tag of that level. And then you can see here there was a big support level back here, still in a very significant level. If the S&P 500 happens to rally up there, that is the purple box I have right here, and that's my maximum bounce target. So it's a range I don't think is going to be hit. Could be, and then really to keep it simple, much above that, it just really hinders or chips away at the case, the bear market case. It doesn't eliminate it. Technically speaking, you have to take out that high to be back in, a new bull and say the bear market's over. But you would have taken out that major reaction high there. You'd be well past the 200 days. You'd be past your downtrend line and past a very significant support level. So again, that is, to me, at this point in time, best case scenario for the S&P 500, which from where we peaked out the other day, just to put it in perspective, that was only another 6.5% from the bottom of my range. So what I consider relatively narrow range, because I'm calling a bear market with plenty more downside to come. And at the end of the day, look, here's what I wanted to convey. I probably should have started with this in the beginning of the video. It has been my experience. I've been doing this, trading full time for a living for many years now, and it's been my experience at one of the worst periods of performance where I'm just, sometimes getting profitable, sometimes giving money back at the end of the year. It's that period between Thanksgiving and New Year's. It's the holiday season. Technical analysis, at least my style, it's tough. And that is because there's a lot of erratic moves. There's year-end positioning, window dressing from the funds. You have tax loss harvesting from individuals and institutions, and lower trading volumes as you head into the holiday season with a lot of people on vacation, including the professional traders. And so therefore, the takeaway here is there is no better time, in my opinion, to take some time off, keep things light. Now, my job is to give you analysis and trade ideas, and I'll do that to the best of my ability. I'm not going anywhere. As of now, I don't have any big Christmas plans this year, so I'll be around, and I'll continue the updates. It just may be a little less frequent, and as you've noticed recently, including last week, I'm focused more on short-term trading opportunities because of that. So I did say recently right here, I expected a couple weeks back, I started saying, look, we've had a heck of a run up. We've hit some major resistance, and we'll probably see the market grind around. And that's exactly what's happened. So so the takeaway, and again, I try to share things that I've learned over the years, and many of them very costly lessons for me. And one of them is, just as you can't squeeze water from a rock or blood from a stone, you cannot extract money from the markets on a daily basis. Over the years, my profits, the big gains, and even the big drawdowns have come in spurts, in periods of time. And then there's periods of time where you just spinning your wheels. And so where I'm going with this, and hopefully you find value in it, I've learned to recognize even in advance when we're likely to see those periods. And what I'm talking about is this right here. And I've been stating it now for a few weeks, and this is what I've been talking about. You're not making money as a swing trader right now. You can't. I mean, I'm talking on the equity markets now. Maybe in one certain stock, and that's what I'll look for. But for the most part, when the stock market does this, you can see now it's gone nowhere since this gap up on, that was November 10th. So all month, almost all month, most of the month, last 3 weeks, we've gone exactly nowhere. We're right to where we started on the 10th. That's where we hit today. So we've gone absolutely nowhere in a range of about not even 2% to the upside and not even 2% to the downsides. Okay, so that is also something that I wouldn't be surprised, and I'd lean towards continuing for the next couple weeks. Why? Because we have the FOMC meeting on December 13th and 14th. So on the 14th, The Fed will make their decision as what to do with interest rates and any changes, if any, to the quantitative tightening. And I can tell you this with certainty. I'll tell you right now that I don't have certainty where we go between now and then, or a high degree of certainty. But I do have a high degree of certainty that one of the most important things in the last year or so, unlike usual, it's not what earnings are about, what the economy is doing. It's all about what the Fed is doing. And so, as you've seen over the last several months, sometimes good news is taken as bad news for the market if it's good news for the economy, because it might indicate more rate hikes, and vice versa. So don't try to make sense of the news and how the market reacts. But what I can tell you with absolute certainty is we've seen probably the biggest impact this year on the market has been those periods leading up to the Fed meetings and coming out of those. So market's probably going to grind around for the next couple weeks. Therefore, not giving a lot of traditional swing trade. When I say traditional swing and trend trading, I'm talking trades that are lasting periods measured in weeks to months. Active swing trading are periods I measure in hours to days usually. All right. Now, with all that being said, if you want my best guess, I would suspect there'll be a downward bias into the meeting. One of those reasons, as I mentioned here on the S&P 500, we just rallied into. We've had several rejections at the 200 on a very healthy bear market rally right off the lows. These are if you thought, and let's say you're new to trading, investing, and you thought and felt that this could be nothing but bullish, what we saw the last couple of months with this rally, it was no different than this one. Little bit more than this one, and if you go back in time in history, it was just a run-of-the-mill bear market rally, as I've covered many times recently, measured by Fibonacci retracements, percentage retracements of the previous moves or the entire move up, and percentage gains compared relative to other bear market rallies. That's what they look like, bear market rallies. That's why I love to trade bear markets, because the gains you can make in a matter of weeks, what you make in months or even years in a regular bull market, because stocks tend to fall a lot faster in a bear market, and they fall a lot faster when they go down. And they also tend to go up faster because you have a lot of a combination of short covering that accelerates those moves, as well as dip buyers that want to keep believing the worst is over. And until we see true capitulation selling, which we have not seen at any point in this, that's one thing lacking. Doesn't guarantee that the bear market's not over, but it would be atypical to see a bear market end without any type of capitulation type selling and spikes into the levels that I'm looking for on certain put to call ratios and in the VIX and other things like that. Okay, so that's that. And then last but not least, if you take a look down here, see these circles that I have? I'll show you. I'll go over, let me turn off all these levels here. You have, this is your PPO, one of my favorite indicators. I talk about it often. And you have a MACD. If you don't have a PPO indicator, a MACD is a very close cousin. It's going to mirror it closely. And so what I've boxed in here or circled are, there's only been 4 bearish well, actually, since the bear market started right here, there's been 5. You get a little bit of whippiness here, and you would say, but 5, you have to look, first of all, I always look above the 0 line. When I'm looking for bearish PPO crossovers as a potential trend indicator or sell signal, it's when the PPO is above the 0 line. So there's only been 5 of those. So yeah, we can skip that one, then say 4. And I'll just show you where. And that was a clean one. This was, I always say, when you're using that as a trend indicator, when you go into a choppy type market and there's not clean separation, I tend to ignore it, okay? This was the first one, and that marked the high, the end of the uptrend, and the beginning of the bear market, the new downtrend. So you got that first, it really got you in on that first leg down. Then you crossed back above, and you had a bearish cross right here, and that was right there, and said get short. And you could either go down to that level. And again, this is not a standalone. You can use it fairly effectively, but I use it in conjunction with other things. There was that one that was below the 0 line, but you did have clean separation, and that was right there after that bear market rally. And boom, another leg down. And then that one there, and you can see how big that drop was. And you can see we have not had a bearish crossover That was a bullish cross there and a kiss. The lines held. If you can see there, you never had a cross. Um, they kissed again. I pointed out that it looked like you were going to get it, and you never got it. That's the one thing that'll happen. Sometimes these lines are poised to cross. They look like they're going to cross, and they don't cross. Now it looks like we're going to get a crossover, and we'll watch for it. And if we do, what do we get it on the other sectors? I covered this just a couple weeks ago. A few weeks ago, I did a sector analysis on the 11 sectors of the S&P 500, and a lot, not all, but most were pending. So we're going to watch. The more of these you get, I always say it's like trying to try a criminal in a court. The more evidence you have against the convicted, or I'm sorry, the accused, the more likely you are to get a conviction. Same thing with trading. So if you get one bearish crossover in one of the 11 sectors, I'm probably not going to bring down the whole market. You get 6 or 7 out of the 11 sectors. Yeah, that's pretty good sell signal, especially in conjunction with the stock market. So enough on that. And again, the takeaway, you can see my levels. There's support down here at about 389.71. That's the bottom of this trend. That's good support. So maybe if you're doing some active trading, you get down there and the chart's confirmed, maybe get a bounce, but be careful. It might be in the wake of that bearish crossover. But again, I don't expect big fireworks, but anything can happen. Never become complacent just because we have a Fed meeting. And just to loop back to that, and I know I'm kind of all over the place here. Remember, as I said earlier, the Fed has been the biggest driver of the markets this year. And they've really, they've always been, people watch, listen, they covered on CNBC, but until we had inflation, runaway inflation in the biggest rate hike campaign in decades, really what they were doing wasn't as important because they were keeping rates super low, artificially low for too long, and everyone knew it and the market rallied, okay? Now, here's where I'm going with this. So not only does just about everybody in the investing public and both institutional investors and individual investors, not only are they all trying to guess and figure out what the Fed's going to do, what it's going to mean to the market, I can tell you this, and I promise you this, the Fed doesn't know what they're going to do. That's the thing. So it's a big wild card. The Fed will take the data. Sure, Powell's not sleeping well at night lately, and they're going to take the data as it comes, and they'll make that decision. It's not predetermined at this point, so just keep that in mind. So again, kind of a wild card. All right, that's that. Nasdaq 100. I was covering the S&P 500 a minute ago. Daily chart. You have also a pending. Looks like we're going to get it, but looked like we were going to get it there, but we didn't, and that's it. So it kissed, stayed above the zero line, and there it is. So you have that, and we did hit, if you recall, we hit my minimum bounce target zone on QQQ, which is right here. We already hit that. So we've satisfied by a combination of just everything that I've been doing for many years, and includes my analysis factors in things such as, but not limited to, Fibonacci retracements, market sentiment, market breadth, how the 11 sectors are looking in the S&P 500 within there, how the market leading stocks are looking, and so much more. So that was, again, a minimum there on QQQ. So I would be not one bit surprised if that was the end of the bear market rally that we had a couple weeks ago, or we come on up here to the top of that. And this is, again, this box is the most likely bear market rally range. This is the, still possible, less likely, but there's that previous reaction high, just like on SPY, and that's where the top of that box is. So you start to take that out, and it does make a harder case to defend the case that the market is still in a bear market if that level is taken out. Now we're well below that right now. A QQQ would have plenty of room to get up there, so keep that in mind if you are, let's just say, well, Randy, I'm with you. I think we are in a bear market and we're going lower, and I'm gonna stay short. I'm gonna stay heavy short. Well, it's possible we rally up there, and that's 18% above where we're at. So you've got to ask yourself, are you going to be comfortable with an 18% drawdown? And the fact that even if you get there to 333, where that level is, there's no guarantee that that's it. So then you're down, 18% from where you are today, or you've given back 18% of your profits. And then where do you stop out? Stop out here, you're going to be, you don't want to stop out at 333.01. you got to give it a little bit of room above there, a daily spike or whatever. Now you're up probably 21%. So that's why, I do this. That's why I spend so much time talking about these levels and focusing on the short-term charts. Because to get from here to here, you're going to have to see some breakouts and developments on the 60-minute charts and the 15 5-minute charts. And maybe I'll get to those here in a second. And small caps, they don't move the needle as much as far as the whole stock market goes, but there's a lot more of them than large caps. There's in this index alone, there's 2,000 stocks in the Russell 2000, as the name implies, or 2,000 companies. S&P 500 only has 500, and the Nasdaq 100, of course, has 100. But there it is. There you've already hit your downtrend line. This is your primary downtrend line right there, and turn off that level. A confluence of those 200-day moving averages, the 200 simple and exponential coming in together. So there's a very good chance that that is it for the bear market rally in IWM. This is a fib cluster, board of fib clusters from the very high, the entire bear market in the Nasdaq 100, which just FYI was a drop so far of 33% roughly. The yellow line, it is a let's see, these lines are overlapping here, and I'm trying to make sense. I believe it's the 50% Fibonacci retracement of that move. I'd have to zoom in a lot tighter. I can do it for you. Yeah, we just hit the 50% fib, and then from this previous high right here, the 61.8. So there's two Fibonacci levels that we were rejected on, and that was 50 and the 61.8 there. All right, so plenty of resistance, both price, moving average, trend line, and Fibonacci. So that, and then on the flip side, we're coming off these divergent lows, which, in a bull market, and if the bear market's over, this is often how bear markets end, with positive divergence on the daily and weekly charts. Maybe we do go on to ultimately break out above that. So stay flexible. And again, the way it works to me is, this is not a be-all, end-all line, but it's certainly a bullish development if the small caps take that out. But then again, I put a higher weighting on what the large caps are doing, and so we'll take this one day at a time. I'll continue to do these updates, and we'll see what happens. But you may want to not short a breakout or stay short above a breakout of that level, a solid breakout, especially if it comes post-Fed. Be nice to kind of just ground around through the end of the year, or at least over the next couple weeks to get past that Fed meeting. But again, I'm going to be telling you the same thing come the 14th of December, whenever the last couple weeks of the year can be tough too, as trading volumes dry up, and then you're prone to more whipsaws, meaning false breakouts and sudden reversals that come out of nowhere because one big hedge fund or mutual fund or pension plans decided to dump big portion of their Apple or buy a bunch of Apple or whatever it is, and causes the market to randomly kind of whip one way or the other. Then just kind of zoom all the way down to the 10-minute charts. It's the world of the active trader. Here's that setup I gave you today, or trade idea on NQ or QQQ. I just had the NQ chart up, and I've been watching this level here. It's about 11,527. One of the levels, I think I did 529 as a typo in there, and then I said 11,527. I fixed that on that post. 1, 2, 3 distinct reactions. We went through there on an impulsive leg down, and that's why I called it at the time. We were right here somewhere. I referred to that as being a likely momentum fueled overshoot, which is where you shoot over and then now you're back above it. Not by a whole lot. For all intents and purposes, we've been back testing this since I gave you that post earlier. But we had divergence here on the RSI. We slightly took out the divergence there on the PPO, so I will say that. But we still had RSI divergence. And I still think there's a good shot. If you took it, you would have took it here, give yourself a little bit of stop, a little room down below. Relative stops are always relative to your price target. I'm shooting for up there around that trend line and or that 11,643 level, which comes in right above it. And being that this is what the market's been doing for weeks now, these are kind of like mean reversion trades. You get a market drops over the next couple of weeks. If it goes up or down 2-3%, it's probably going to swing back and go the other way. Up 2 or 3, people take profits, and short sellers step in. If it drops 2 or 3, the bargain hunters that believe the Santa rally is coming, they're going to step in and buy. And so that's why I'm, after this drop, why I'm looking at a long side bias instead of shorting a break right there of support like I might normally. Okay, next up, Treasury bonds. That's something, I've stated in the last couple of months. I've had, that's the only place, where the biggest position in, 401k type accounts for me. Safe, I thought the risk reward was the best, and that had to do with yields. What we're looking at, yields, this is the yield of the 30-year, and remember, it moves inversely to stock. So we're building these divergences, and we also ran into long-term resistance, which I'll get to in a second, and then waiting forever and a day, it seemed like, but it wasn't that long for a break of this trend line. We got it right there, and that was, as I stated at the time, most a very powerful buy signal on bonds, because yields would drop and they'd come down to this trend line right here, and they did, and trend line and price support. So we hit that. So that was yesterday. Well, no, we hit it I guess on Friday last week. Either way, yesterday I took away, took profits on half of long-term trend positions that I had on treasuries. And remember, I remain, well, at this very point in time, I would say short-term bearish on treasuries, or to neutral, because we just hit support. So I, took profits on the longs. Remember, treasury, I'll get to, I know it's confusing, I'll get to the treasury bonds in a second. I just want to really focus on the yields. And then still longer term, I believe yields are going higher and treasury bonds will continue to fall. So I remain longer term bearish. And but intermediate term, short term, kind of not sure. So just kind of flattening out here right now. But I do think we'll ultimately break this, whether we get a tradable bounce off there or not. I think we'll break that trend line and continue lower. So that's TYX, is what it looks like on the weekly chart. See, there's the this shows it a little clearer here. There's the primary uptrend line off the late 2021 lows. So yields have been rising. Remember, interest rates, mortgage rates got above 7%. Really cooling things down, and that's a big number. So there's the breakdown, and so I think yields will continue to fall in the intermediate term, weeks to months. Okay, days I'm not so sure about, but weeks to months, and I think we'll fall back to, you can see here, there's our long-term primary downtrend line. That's from our secular bear market. That's a major trend line that goes back all the way into the early 80s. We broke above it. We blasted right through it after a little consolidation. So I'm looking for a back test, either all the way down to the trend line, or at least that 35-ish level right there. That'd be about 3.5% on the 30-year bond, and you can see here on monthly. There's that long-term trend line right there. I have a couple of variations. So that's that. TNX is a 10-year, very important one to watch as well. Did the same thing, broke above its long-term downtrend line, which also supports the case that, and I've been saying this all along, I think this bear market is going to be a lot different from the ones over the past couple decades. And it's going to be plagued with periods of abatement and inflationary pressures, and then talks of the Fed, being less hawkish or even going outright dovish. And at some point, I do think next year we'll see rate cuts. And then those cuts I think then it will re-spark inflation, because I've made the case repeatedly for the last couple of years now that commodities are in a new bull market, an early stage bull market action, just like interest rates, more importantly, are in a new secular bull market. By most metrics, the secular bear market that goes all the way back 40 years, about 40 something years, is over by just about every technical metric, including a very well-defined downtrend line and taking out previous highs and everything else. So therefore, we could probably come down a little bit, and that means bonds rally, and then at some point we'll resume a bear market, and it'll be probably years, if not decades, of the Fed struggling with inflation. And every time the market thinks it's over, like recently, it'll rally, and then once they realize it's not, and the Fed needs to be tough, then rates go up. And kind of like Japan, lost decade of Japan. You can Google that one if you haven't already. All right, now let's just look at the bonds themselves. TLT, 30-year bond. Remember, this was the trend line. We were waiting for that uptrend line on TYX to break, which it did, and of course this is just the yield upside down as the bonds itself. This is what you trade, either this or ZB, 30-year bond futures. There was our breakout candle, and so you really don't see. That's why I wanted to focus on TYX, showing you the yield, because you don't have a lot of resistance here. Maybe I could draw on a trend line like that, but it doesn't come in exactly the same. So the yields are really what makes bonds tick. As I said before, that is an immutable relationship. There are fungible relationships or variable relationships between things like gold and the US dollar. It's kind of an on-off thing, mostly on, but sometimes off. But there's no variations of direct impact or inverse correlation between the yields of Treasury bonds and the prices. So anyway, that's it. So the risk reward right now, this was a nice leg up. I think there'll be more to come. That's still a max potential target, but in the near term, kind of maybe go into a holding pattern as we wait the Fed. So hopefully that's an update for you. There was here I'll show you on ZB. If I zoom down short term, this is just a 10-minute chart. So recently we put in this high right here, divergent high that is, I'm sorry. We had negative divergence building on the 10-minute chart. And that's why these 10-minute charts are really my go-to lately. And then we had a little support level here was broken. You had an uptrend line broken there. And we've been zigzagging lower, and so we broke down. We hit this nice support right there. You can see 126, 129. So these are still tradable. They're just not right now, in my opinion, very swing or trend tradable. I'd move more into active trading mode, and even more recently, a little divergent high right here. You can see that before the breakdown. No divergence at this point in time, so what I suspect will happen, we'll go here and we'll probably next run at 126, 129, break it, and then run down. There's certainly some support about right here, halfway down, but that should probably take us all the way down here to about that 125-ish level right there. So I do see, favoring near-term downside in bonds and favoring near-term downside in equities. Forget about the very short term that I showed you on NQ. I'm talking drifting into the Fed. If I had to take my best guess, I'd say we see more profit taken on equities and bonds heading into the FOMC meeting. Okay, and last but not least, I'll do the energy in another video or static charts, but just a quick update on gold, silver, and the miners, because that's been a trade I've been focused on lately, and told you I took some profits in the gold and silver and the miners a couple weeks ago. As we hit, most importantly, the euro. This is the euro. Remember, this is the euro US dollar pair, and the euro is the biggest component of the dollar index. So it's just like looking at a US dollar index chart upside down. And this was a major long-term support zone. That's how I had it labeled for a while here. And we took it out, and I said breakdown or fake down bear trap. And that's to be determined. All we're doing now is a back test, and that's the thing. We're back testing, as I mentioned recently. We came about 3/4 of the way up to the top of the resistance zone right there. I could see the potential for more upside, but we may not get there because, again, the bottom of this is our resistance zone, and we're in it. And so therefore, again, my near-term convictions on where the dollar and the euro and gold go is not very high, but I'll be very clear. I'm still longer-term bullish on gold. I'll get to that chart in a second, and silver. Near-term leaning towards the bearish side. Here's why. Remember, they moved this rally in the euro right here. This move up off that. This is a daily chart. If I didn't mention, I was on a weekly a minute ago. This was a divergent low, i.e., oops, not what I wanted. I wanted to circle that, show you divergent low, and that's positive divergence right there, and that's at the stage for this uptrend. We've been zigging, zagging our way up, right? But recently we put in a divergent high. Now divergence is not a sell signal. It could continue to grow, so we could work our way up here. There's a major trend line there. If we get there, I would tell you with more conviction that I think we're going to move down to this trend line or get a bigger reaction. But remember, this was also a tag of that resistance zone on the weekly chart. So it's, to me, 6 to 1, half dozen to the other, whether we're going to go up a little bit higher, and that would give us a near-term carry, head or tailwind be near-term bullish for gold and silver if we can run up a little more. But the risk reward, here's the thing, guys, the risk reward isn't very attractive because I don't see a lot of upside before, and we're already building divergence. Again, if we go up a little more, that divergence will still be there, and then it'll probably just set the stage if we do go up a little more, to have a reversal and come back down and probably test this uptrend line right here. That would be a net headwind for gold and silver. When I say a net headwind, there are times where the euro can fall. I'm sorry, the dollar can fall, the euro rises. They tend to move, gold tends to move inversely to the dollar, which is positively correlated to the euro. But there are periods where there's overwhelming demand or supply, meaning more people buying gold or selling, and that's where that relationship can disconnect. But for the best we can do is help align our trades. The best trades for me for gold and silver come when I can also make a pretty strong bullish case on both the charts of gold and silver as well as the charts of the euro, which also would be a bearish case for the dollar. Okay, so that's that. Convictions aren't high where we go, but if we look at the 60-minute chart, I already showed you on the daily we had that divergence put in. There's also divergence here on the 60-minute chart, right? See it here? And a nice clean trend line that was just broken. So yeah, so I think gold and silver are going to probably continue to struggle for a little while. I'd be a buyer if we get more of a pullback, or if we go up a little more and then pull back. Also look to reload on some of those trend positions I closed out recently. Okay, and the big picture on gold, this is a weekly chart at GLD, the gold ETF. This was major support here, about 157 on the daily. I think I have it at 158. It was a nice breakout here. We had a period of consolidation back in early 2020, and then gold ran up, hit its previous, you could see that was the previous bull market high right there at that time, and after being bullish really off the lows here, and then very bullish once we get the breakout of 130. Its trend and long-term positions had taken out, selling all my long-term positions, looking for a nice correction because that was a major resistance, major reaction high, and we hit it, and then we hit it again here. So we've had, this is a big level, and I think we're going to run up there again and ultimately break out of that level. It's going to be a little while probably, but I think that's the longer term, 2023. Is when I suspect that'll happen, after the first of the year sometime. But more recently, so we had the correction. It's been a bull market correction, period of consolidation. We had a breakdown, which I suspected would be a false breakdown, aka whipsaw, bear trap, and that is 110% as of now what that is, or was, because you recovered it, and you recovered it impulsively. So that means all those that shorted gold when it broke that key support level, all those shorts, were squeezed out, and if they weren't yet, they'll continue to be. It looks like maybe a bull flag possibly here on the weekly chart forming. That would take us up to this next resistance, about 174, if that plays out. However, again, we're going into an FOMC meeting, so I think the currency markets, the euro and the dollar, may kind of grind around. What trader wants to take a huge position not knowing what the Fed's going to do? Probably not many. So again, it may be a kind of a slow grind, and this is that, and here's that 158 level I just talked about on the weekly. Then I jumped down to a daily here. Remember, it wasn't just the recovery. We had positive divergence, and that was helped indicate that this breakdown would ultimately fail, and we'd recover that level. So as long as we remain above 158, longer term bullish. Near term, like I said, gold's going to do what it does. If it went down to 158, that would be an objective buy. It already was an objective buy at that 160, 130 support. And if it can break above the recent high, again, any breakout that occurs between now and the Fed in a couple weeks, I would take it with a grain of salt for the reasons that I said before. All right, so that's that. Silver will almost always follow gold. This is what let me see if I have anything for you on the silver futures. See, it's just kind of that's the thing. So the takeaway is this, guys: trade if you want to trade. That's what I'm here for. I'll give ideas. If not, it's a great time to take some time off. Keep an eye on things. Watch if anything compelling stands out. I'll certainly share it with you, and I'll also always try to share when my convictions are high on something, or I'm just throwing out trade ideas that are potential. But you can see here, it's just going up. You make a divergent high, you get a correction, divergent low, you get a rally. Right now, I can't make heads or tails of where silver or gold is going based on these short-term charts. Maybe a little trend line there. But you can't really draw a triangle or an uptrend. I can just tell you my first decent support is down here at about 25.49. I suspect that before the Fed meeting, I suspect this is where we'll work our way down to this uptrend line, and that if we get there on silver, and at the same point in time, if gold is at a decent support, I don't have any great levels. I'm going to add one right here for you. Yeah, I may, maybe a trading op or even re-entry. But if you're a long-term investor trader, like I said, you can keep buying gold, scaling in, buying pullbacks. I just wouldn't buy if GLD drops below 158. At that point, I'd be more concerned about where to start stopping out if it continues much lower beyond 158 on GLD. All right, I'm going to wrap it up here, get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.